What's up, everybody? It is Flashwing, and yes, potentially to some of your excitement and potentially to some of your chagrin, I'm doing another podcast today, and it has just been it has been some crazy time since I've posted on my channel. I first want to say welcome to those of you who have subscribed since my last video. I have to admit I've been a little surprised that I've still been gaining subscribers and not just hemorrhaging people at a pretty broad rate. But thank you to everybody who's recently joined the channel. Those of you who have been with me for a long time, as always, I appreciate your continued support. I've got a lot to cover today, and some of this is going to be completely out of left field from things that I've talked about here on the channel. Given the title of this video, which I've yet to make, but I have an idea of what's going to be. This is not a financial channel, and I am not a financial expert. This is a channel of ideas, and a channel that tends to follow my own interests, which include everything from filmmaking, as bad as it might be, to politics, to motorcycles, to racing, to life, to personal development improvement. It's pretty much whatever interests me ends up on the channel. And thank you again. I can't really express my appreciation for everybody who continues to be part of this channel and watch my stuff. There's not very many of you left because I know many people are here for motorcycle things. But I always feel the need to get a lot of this out. Like I feel the strong need to get it out of my system. And the topic that I want to cover today has been a significant forefront in my own life in the past couple of months, but the past month and a half. So let's say the last 90 days in particular. Today I want to talk about cryptocurrency. And I know that could potentially interest some of you. For there are maybe others of you out there where this just causes your eyes to glaze over. But I promise you that if you stick it out with me, you're going to be significantly better informed than many of the people that you may have talked to about this topic or heard talk about this topic, and most certainly be better informed than many people in the media who reported on this topic as well. Cryptocurrency has been in the news for the last couple of months, most certainly since since Thanksgiving, because of the enormous explosion in the trading price of Bitcoin in particular. And it has attracted a lot of attention, not only from individual investors, but also to regulatory agencies and indeed whole governments of countries, because the price has just exploded. I believe that year over year, the price of Bitcoin has increased by well over 1,000%. And as you can imagine, anything within the investment world that has that kind of a return within a year, it's unprecedented in financial history, shortly outside of anything that's fraudulent, of which I know that there's an opinion out there that Bitcoin is a fraud. So I'm going to go over a lot of stuff. The purpose of today is not to talk about Bitcoin as an investment, because even though that is most certainly the driving force behind what we're seeing with cryptocurrency today, which is a speculative investment. And by speculation, it means that you are speculating that the price of whatever it is that you're buying into will be worth more later on than it is worth now. And people speculate on all sorts of different commodities. They speculate on oil, on gold, on anything like that. It can be seen potentially as a speculative investment. But I don't want to talk about it from a standpoint of an investment, because that's what's getting people in the door, but that is not what is going to sustain the development and use of cryptocurrency in the future. And that is the meat and potatoes of what I'm going to go over today. But before I get into the technology, I want to talk about the big picture, because that's what I'm always about. And I think that that's the best way to connect the bridge between the chasm of people who are diehard cryptocurrency owners and supporters, and we'll just argue everybody else. So there's a lot of confusion about what cryptocurrency is. I'm not going to go over some of the rumors and not really necessarily dispel them, because I think that after you listen to this, you'll be able to get through it all on your own. The thing about technology is, technology has a lot of different uses, but solving problems is one of the biggest central categories that technology is able to provide. It's looking at the market, determining a need, and fixing something that's out there, whether it's productivity or just a need or a service. Cryptocurrency most certainly solves many of the problems that we currently have within our overall financial system. And many of the things that it solves, it does in a very, very a very foreign way, a way that if you were to extrapolate it across our entire way of life, it would be a way of living that is so incredibly foreign to all of us. But it is a way of living that could potentially solve a lot of the problems that we have, or at least some of the perceived problems. And when I say perceived, I mean the problems that people think that we have, but are more or less just reflections of reality, such as income inequality. So I guess I could start with some real brief history about Bitcoin in particular, and that's what I'll focus on, because while there are about 1,400 other types of cryptocurrency that do a whole bunch of other things, many of which actually are not even designed to function as a currency, but more as a decentralized network, Bitcoin is the one we'll focus on, because that's the one that people are familiar with, and it kind of helps introduce you to a lot of the more complicated forms of cryptocurrency or crypto assets. So Bitcoin was originally developed in 2008. In fact, the official date, I believe here, according to Wikipedia, is August 18th of 2008. It was when the Bitcoin.org website was actually registered. And in fact, the very first, for an interesting fun fact, the very first Bitcoin transaction was 10,000 Bitcoin, which would be worth an astronomical amount of money now, was used to indirectly purchase 2 pizzas by Papa John's. So the reason why Bitcoin was developed, which it was made by a individual who goes by a pseudonym of Satoshi Nakamoto. We don't actually know who Satoshi actually is. The individual who developed this is not known, which adds kind of to the mystique, but potentially to some people that's considered to be a serious red flag. We don't know who made it, God forbid. So why was Bitcoin made? I think this is the first stop that we need to make. Bitcoin was made in response to the 2008 economic collapse that happened in the United States. And the brief history about the economic collapse, which is something that I've done a lot of reading about and a lot of understanding about. And the thing you may have seen a movie called The Big Short. If you haven't, I absolutely recommend watching it. It is a good, somewhat informative film. I'm not familiar with exactly how much of the film is real and how much of it is fiction, but what it covers is the financial mechanisms within Wall Street that led to the collapse of Bear Stearns, and the collapse of the economy in general, and the brink of destruction that we were brought up to. My focus has mostly been on the governmental side, on the legislative side, and all of the things that sort of laid the foundation for Wall Street to do what they do. It's important to point that the 2008 economic crisis was most certainly driven by greed. It was driven by all of these absolutely reckless financial instruments, and a complete disregard for the facts that were in front of many people in Wall Street, including, I might add, the regulatory agencies that everybody loves to cite as the watchdogs of the financial industry. The regulatory agencies were also in on the crisis because there was money to be made everywhere. On the government side, it's important to understand that since the early 1990s, this is when the crisis actually began. It didn't start in 2008. It actually started all the way as far back as 1992, where various different credit based legislation was relaxed for banks. The innovation and creation of electronic credit monitoring, not credit monitoring, I apologize, but credit checks in particular. Because see, it used to be, for those of you who are, younger in the audience, or those of you who need refreshers who are my age or older, you have to understand that getting credit, like loans, like if you were getting a car loan or if you were getting a mortgage, or even a credit card, you had to develop relationships with banks. And this was often done on a local level. You had to develop a relationship with a bank. And banks didn't just loan out money to people because a computer said that you were okay to lend to. They loaned out money because you had a relationship with the bank. You had a bank account there. They've done business with your family. But the fact is that you had to build a personal relationship in order to get a bank to loan you money. There was no real other way to evaluate somebody, with the exception of things like, assets and income and things like that. But it wasn't until we had the formation of the three major credit agencies, one of which fairly recently had one of the worst security breaches in the history of mankind, and then was later given a contract by the IRS to help police tax fraud. The irony there, I hope, doesn't escape anybody. Prior to the three major credit agencies being instituted and ultimately this electronic credit checking being put into place, this was the way things were done. So what happened was, over time, the standards for lending by banks were relaxed. And then, of course, there was this faulty study that was done in 1989 in which they basically looked at all the loans across the United States. And because minorities had a smaller proportion of loans compared to whites, then it was automatically deemed that banks were racist and had racist lending practices. And the study was later debunked by pretty much by anybody that has an understanding of statistics and understands that you just can't take, correlation is not causation, I guess, is probably the logical fallacy that was applied there. I don't know exactly who debunked the study, but I can tell you that it's debunked based on a logical fallacy on its face. So, but what happened is in the meantime, that study was actually taken by Fannie Mae, who was fighting the U.S. Congress at the time, because Fannie Mae is actually an appendage of the United States government. They basically can loan out money at a reduced interest rate because their loans are secured by the federal treasury. They're backed by the full faith and credit of the United States. And that actually allowed them to make a substantial amount of money because people could get loans from Fannie Mae for, as much as 0.5% below the going interest rate. And because, of course, they had all of these guarantees because the federal government would back up all your money. So they didn't have to worry about losing anything. And the risk was really low, or at least lower than you would find with any other normal bank. So Fannie Mae, during that time, Congress was thinking about decoupling Fannie Mae from the federal government because in a sense, Fannie Mae is a private company. In the same way, in a similar fashion that Planned Parenthood is a private company but receives a substantial amount of federal subsidies. So, of course, this would have been detrimental to Fannie Mae's business. In fact, it was derived later on in the mid-'90s that as much as a third of all the profits that Fannie Mae was producing on an annual basis was due exclusively to the fact that they were backed by the quote-unquote full faith and credit of the United States. So they were trying to find a way to prevent Congress from decoupling them from the federal government, and they're scrambling around trying to find anything they could get their hands on. And so what they did was they found this study in 1989 saying banks were racist and not lending to minorities, and they said, this is it. So what they did was they began essentially what would later morph into the subprime mortgage lending, where they started intentionally targeting minority lenders, or lendees, I guess. And they started on this crusade to get both minorities and the poor into homes. That's the American dream, is owning a home. I promise, stick with me. This is all gonna wrap back around to currency. Just bear with me. This is a long-winded bit of history that you have to understand. So they they made it their crusade in the early 90s to start lending out to minorities and to poor people, and doing it subprime being under the prime rate of interest. So eventually they accumulated a pretty good following, or at least a pretty good portfolio, of poor and minority homeowners that were, they had loans of. So that being said, every time Congress would go to the floor and start talking about decoupling Fannie Mae from the federal government, they would of course come out and say, do you really want all of these poor people and these minority folks to be thrown out of their homes, or to not have the opportunity to own a piece of the American dream? And the emotional argument was so overpowering that Congress would not dare remove Fannie Mae from the federal government. Well, fast forward to 2008, where you had a situation with these mortgage-backed securities where they would take mortgages and they would group them together into a security, and then they would sell that to another, they basically sell it up the investment chain until eventually it would get to Fannie Mae, because Fannie Mae executives received substantial payouts and bonuses for the size of the portfolio. So the more assets they accumulated, the bigger their bonuses got, until eventually it became so huge that a collapse was inevitable once you had the housing bubble burst, which of course was also preempted by people who had been put into adjustable rate mortgages, where they had these balloon payments that popped. No one could afford them. They were defaulting on loans. Houses were then being foreclosed on, and you had all these foreclosures in all these neighborhoods, which drove down the price of houses. And it was just a fucking mess, just an absolute mess. And while, yes, the eventual financial collapse within the industry was driven by greed, and it was driven by Wall Street mechanisms and financial instruments, you need to understand that the foundation for all of this was laid by the federal government. It was by the U.S. Congress. So, the control mechanisms are right there. If the foundation hadn't been laid, Wall Street wouldn't have had the opportunity to do what it did. So I know it's a very long bit of history, and that is just barely scratching the surface. There's a number of great books out there that if you're interested in this subject, which I would encourage you to be, because it can and most likely will happen again in this country. It's very important to understand what to look for and what the risks are to you. So the 2008 economic collapse is what prompted Satoshi Nakamoto to create Bitcoin. Now, why on earth would somebody be driven to create a piece of software? Well, the thing to understand is that Bitcoin is based on cryptography. And I'm not going to go too deep into the cryptographic aspects of it, except to understand that it is what allowed Bitcoin to become the very first digital asset, or digital file, essentially, that cannot be duplicated. It cannot be faked. And that's a huge, huge innovation. Because up until 2008, anything that's created on a computer system that is digital can be copied. Anything. Movies, music. We were 8 years deep into the illegal music and movie downloading industry, which started with Napster around the turn of the century. Everything can be copied. Anything that is digitized can be copied without exception. So what this created from a standpoint of money is, it was impossible up until that point to use digital currency in a respect that was not tied through some central authority. So think like Visa, MasterCard for like credit card payments or debit card payments, because it escapes me at the moment, but there's actually a term for this. But the notion that you could go into a merchant and buy something with digital currency of some kind, not dollars. Think like gold pieces or something, whatever you want. And then you could walk right out and duplicate that same currency, and then go into another store and buy something with the same currency that you just gave to the previous merchant. So that obviously won't work, because you create an inflationary situation there where people have an unlimited amount of money, and economies just don't function that way. So what we ended up needing in this instance is some type of a centralized or central authority, We needed a central ledger, somebody that can say, yes, you have spent this money, and this money is no longer available to you in your bank account. And so you could use Visa as a prime example of this. So you use your Visa credit card, you go into a merchant and you spend money, and then that expense is put on a ledger that Visa maintains that says you spent $10 at Starbucks. And so you can't go into the Starbucks down the street and spend the same $10. In the case of Visa, they'll go, oh, so now you have spent $20, 10 at this location and 10 at this other location. So, but you need a centralized authority for this to work. And there's complications that come with this type of central authority. In this case, you need permission to begin with. So those of you out there who don't have very good credit, you'll understand what I'm talking about, because you are beholden to the credit reporting agencies as a determining factor in whether or not you can get loans. So these different supposedly independent companies all look at these different factors within your life. And if you know anything about credit ratings, you'll understand that just about everything is a double-edged sword. So as an example, if you have a high amount of credit that you have available to you, let's say you have $50,000 in available credit that you can spend. The credit reporting agency would look at this and go, on the one hand, this is really good, because this means that you have that banks or someone entrusts you with a lot of money. So if that's the case, we're going to raise your credit rating because this means that you're very trustworthy. But on the other hand, we might lower it a little bit, or not give you as much of an increase as you might have gotten with other amounts of credit, because $50,000 is a lot of money. And if you went out and spent $50,000 on a credit card in one day, you could economically wreck yourself or financially wreck yourself. So that's risky. And so having access to a lot of money is both a good thing and a bad thing. And it's like this across the board. Other factors such as like how many physical accounts you have. Strangely enough, the more accounts you have, the higher your credit score goes. But it's the same problem. You have all these accounts open, which increases the potential for fraud, and that's risky too. So it's this crazy system which is designed to both help you and ensnare you at the same time. That's just an example, but essentially you need permission from a central authority to spend your money. And if Visa decides that for whatever reason that they're not interested in allowing you to spend money on something, then that's exactly what happens. And I'll give you an example that just happened a couple days ago, where Capital One, which is a very, very large financial institution in the United States, Capital One has decided that it's not going to allow any of its customers to spend any of their money on any cryptocurrency purchases. Straight up. Bank accounts, like credit, like checking account, savings accounts, although it's not as prevalent there, but we have people on areas of the internet who have claimed that they have been restricted as all the way up to having their bank accounts closed by Capital One if they have bought cryptocurrency assets within, say, the last month. But most certainly any credit cards. Now, you can have your own opinion about whether or not people should be using credit cards to purchase cryptocurrency. The point is, these people have permission to spend money. They should be able to spend it on whatever they want, provided that they meet the terms of the credit agencies and that they pay the money back. Otherwise, it's not the bank's business what I'm buying with the money, as long as I pay it back. So this is one instance where Capital One has decided, we don't like this thing. We don't like cryptocurrency. We think it's dangerous. We think it's a scam. It's a fraud. It's used by criminals and prostitutes. So we're just not going to allow you to buy it. You have to pardon my bluntness, but fuck you. It's none of the bank's business what I spend my money on, as long as I agree to pay it back. But this is what you get with a central authority. It's the same thing with banks in general when it comes to storing cash. So when you have a central authority, everything is permission-based. Now, we all think that we're free. We all think that we're free to spend our money on whatever we want, although I think I've just articulated one instance where that's not true. We also think that we have access to our money whenever we want. And this is another major component to the creation of Bitcoin, which is the potential of a bail-in with a bank. So you have to understand that banks were put in a very bad situation in 2008 because they owed a lot of money to a lot of people. And in order to pay someone money that you owe them, you need liquidity. And liquidity just basically means you need cash on hand. You need an asset that someone will accept. So as an example, if you were in a financial crisis and you owned 50 homes, but you had $0 in your pocket, you had no liquidity. Like, you would have to liquidate your assets, turn your assets into cash in order to pay your bill. So banks, thanks to federal legislation within the United States, prior to 1992, I believe, were required to have 10% of the sorry, I'm getting all discombobulated. For the total amount of assets that they have, all the things that the bank owns, all the assets, their homes, the cars, all that stuff, they had to have 10% of, and this includes all their loans, I might add as well. So let me back up. I'm getting ahead of myself. So for all the loans that the bank has out, they have to have 10% of the total value of all their loans in assets and cash. So that means that if a bank loans out $1 million, well, let's just make this easier on myself because I went to college. I can't do math. For every dollar that the bank lends out, they have to have 10 cents in actual assets and physical cash in hand. Okay. Then the federal legislation lowered that to around 1 to 2%. So now, if you're a bank, for every penny that you have, you can loan out $1. I mean, how fucking crazy is that? You want to talk about creating money out of thin air? Holy shit! So for every dollar you lend out, you only need a penny in actual assets and cash to back that up. So the banks had no liquidity, and they owed money to people everywhere. And so then what ends up happening is that in order for banks to survive, they have to raid the cash of their customers. So that's exactly what they did in some cases. Not in the United States, because the federal government swooped in at the very last minute and basically gave a shitload of money to the banks, like billions of dollars to the banks in liquidity, and allowed them to stay afloat. And of course, at that point, it essentially nationalized the banks. The banks became instruments of the federal government. So in this case, we managed to avoid a bail-in situation, but I'm here to tell you that the Dodd-Frank legislation, and I know this is just boring as hell, but you really need to know this. The Dodd-Frank legislation, which was passed in after the 2008 economic crisis in response to it, basically makes it so, yes, the banks will survive another financial collapse, but you will not. And I will not. Because our money will be gone. Because the bank will be authorized to use our cash to save itself. Let that sink in for a second, okay? I want to make sure I'm as crystal clear as I can be. That the banks, if they are in crisis, have permission from the government to use your money to save itself. Now, what happens? What happens when they use your money? It's gone. It's gone. You get a IOU, essentially. Or you get an asset that ain't cash, as I will emphasize later. So then, of course, the very first thing that people like to tell me is, well, it's FDIC insured. The FDIC, which is basically a bank insurance program from the federal government, does not contain nearly, not even close to the amount of liquidity that would be necessary to save even a single bank failing. There's very, very, very little funding to the FDIC. It would take a congressional act to fund the FDIC enough to save a massive amount of bank accounts. And you're going to have a hard time. I'm sorry. You're going to have a hard time convincing taxpayers like me to bail out people, to bail out a bank or bail out people in a bank using taxpayer funds. I'm sorry, even if it's me, that's someone else's tax money bailing my ass out because a bank didn't do what it was supposed to do and made bad decisions. Like, this is the world that we live in. Let me wrap this up in a very neat little bow-tied way. When you put your money into a bank, it ceases to be your money. It becomes the bank's money. And the bank can do whatever it wants with that money. And even if, for some reason, there's some measure of fraud or a criminal activity or a mistake, you may still have to go to court in order to get your money back. And even then, you're not guaranteed anything because courts are ran by people and people are flawed and they make bad decisions. And in the meantime, you have no money. Litigation in court takes years. Years, people. I've been there. Trust me, I know. It takes years. And meanwhile, you got no fucking money. So you need to understand very, very simply that as long as we have to submit to a central authority when it comes to finances, your money does not belong to you. The illusion that your money belongs to you is in place simply because you can go to any ATM 24 hours a day and get your money out. But here's a question. Can you go to an ATM and take out $5,000? Seriously, you can't. I don't know about you, but where I bank at, I can only take out $300 a day. Now, if I want to take out more, I have to go into a bank branch. But have you ever gone into a bank branch and asked them for a large sum of cash now? You can't get it. They'll tell you that they'll take 24 hours because they don't have the physical cash on hand. They don't keep cash in bank branches anymore. There's no big vault full of cash like you used to have with local banks. Because there's been a war on cash for, I would say, the better part of a decade and a half now. Well, why would people be so against cash? Well, for reasons that I will articulate later, because cash has a lot of characteristics that are shared by cryptocurrency. Cash is anonymous, which means that you buy and sell things with cash and no one knows about it. It's not traceable. It's not trackable. Unless somebody keeps it in a ledger somewhere, you can buy anything with cash and no one will ever know. There's no way to trace it back to you. No one keeps track of which physical serial number, of cash that you have. So it's completely anonymous. That's one of the major problems when it comes to dealing with, when it comes to tracking people's finances. And of course, the federal governments, in particular the IRS, are interested in tracing every bit of funding that it possibly can because everything you do is a taxable event for the most part. And cash is one of those instances that could prevent people from being on a ledger that would allow the IRS to see that you're not paying your taxes. That's really for the most part where all of this is summarized, is that as long as the federal government gets what money that they feel that they're owed, they really don't give a shit what you do. I've had some friends of mine locally that I know in person where there have been some upsets within the financial world, to which I've commented that they'll probably not go to prison as long as they've paid their taxes. And even then, they may just pay a fine, and then that'll be it. This is how the system works. So cash is ultimately a problem for countries because it's not traceable, it's not trackable, and it's not taxable if you don't know anything about it. As a sidebar, I was talking to somebody I know recently about his wife who works as a bartender. And there was a discussion about declaring tips on your taxes. And I was making the comment that in the past, I knew people who would only declare like 50% of their cash tips so that they can keep and not pay taxes on the other half. But now the IRS actually looks at the ledger, looks at the records for the restaurant in particular, and extrapolates based on your reported income, not your reported income, I apologize, extrapolates based on the intakes from the restaurant. So how much money the restaurant's making from selling food and drinks as to how much you approximately should have made in tips. So, I mean, they're going to do whatever they possibly can to get your money. And having a digitized financial system will make this incredibly easier. Because now, as an example, if you work in the hospitality or restaurant business, a lot of people pay tips through credit cards. Well, they're automatically reported to the IRS because it's all electronic. So cash is the only sort of last bastion that you could potentially avoid having to pay taxes on it. But as we've seen, the IRS is finding new ways every day to make this happen. The other thing with cash in particular is you become your own bank in a sense, because there's something very important to point out. And I'm not the person to come up with this notion. This is something you'll find in a lot of the different cryptocurrency sectors, I guess you could say. The way that our financial system works right now is there are very, very few peer-to-peer or direct transactions that get fulfilled these days. So very few money, person A giving money to person B. What it is there's a corporation in between every one of these people. There's a bank, there's the government, there's a store, there's always a corporation, but mostly a bank in this case, that stands between you and the person that you are paying. And every time there's a corporation that's a middleman, they take a cut. As an example, you use your credit card, okay? When you buy something with a credit card, the retailer pays a percentage of whatever it is that you gave them to the banks in fees. And then you, as a credit card holder, you may pay an annual fee for your card. Some of you do. I certainly hope you don't, but you pay interest on the month-to-month balance that's carried on your credit card. So the banks make money coming and going. They charge the retailer a percentage of whatever they've sold as a fee for using their service, and then they charge you interest for loaning you the money that you use to purchase something. Just an example. But there's always a corporation in the middle. We very rarely pay someone directly with cash or with dollars or whatever, or fiat currency, we'll say. And we call it fiat currency because it can be created at fiat. It can be created anytime. So this is another reason why digitizing money is so vastly important to corporations and banks in particular, because they can make money off of it. Nobody makes money giving cash. No corporations make money if you use cash. So that's another major factor. So what we have, and then of course there's another segment to this, which is we have to come to terms in order to understand cryptocurrency. And there's been a lot of discussions about intrinsic value, which is just essentially a value that's based up in what something is or what it does. I don't have an example off the top of my head, but I don't know, like an automobile has intrinsic value because it can provide you transportation, things like that. But value in particular is a very, very common subject with respect to cryptocurrency, in that it has no value because A, it's not real, and B, because it doesn't do anything. I'll discuss this later. But in order to understand why cryptocurrency is so revolutionary and why it's so important, to do this, you have to come to terms with the truth about our own currency, about our own economic system. And that is that the dollar. Now, I have listeners in different parts of the world. It's going to vary from place to place, but fiat currency, paper money, things like that. That's what we're talking about here when I refer to the dollar. The dollar only has value. Now, pay attention. This is, all right, pay attention. Look at me. This is important. The dollar only has value because the U.S. government says it does. Okay? Like, this is it. We all think the dollar has value because all we know as average people on the street is I go into a store and I give you the money and you will give me the pussy magnet. That's how this works. That's all we know. But the fact is that the dollar only has value because the United States federal government says it has value. It says it has a dollar. Now, in terms of how much value it has, that is determined by the market. How much a dollar can buy you is determined by the free market. And that's, of course, it buys you less and less and less every year, doesn't it? You know, I have a common discussion. I work within the IT industry, and I've had discussions with people in which I tell them, hey, just so you understand that wages within the IT industry are flat, which means that somebody working my position back in 1990 was probably making the same amount of money, but that money went a hell of a lot farther. You know, so people are making the same amount of money in the IT industry, but it's actually less spending power. So you have to understand that the entire fiat currency system can basically be summed up as being inflationary. And it is also only worth what someone else tells you it's worth. Now, this is really dangerous. It's really dangerous because what it means, and you're going to hear me typing in the background because I just realized that I completely forgot something. So I'm gonna screw this up because I can't find the article very easily, and I don't want to sit there and type in your ear. So several years ago, I'm going to give you a prime example. So I'm going to loop back around, and I apologize because I'm doing this all in one take, and it's just kind of like flowing out of my head. To give you an example of what I'm talking about and how dangerous this is, how dangerous it is that the money that's in your pocket, potentially, but the money that is in your bank account is only worth what the federal government says it's worth. This is incredibly dangerous because what it means is that at any time the government can suddenly decide that the money that's in your pocket is worth nothing. It can. It happened in India a few years ago. So a few years ago, the Indian government came out and said that it may have been the 500 rupee note, but I know it's the 1,000 for sure. That let's say the 1,000 rupee note in 50 some odd days, 52 days from the point of the announcement, the existing 1,000 rupee note would be worth nothing. It would be illegal to have it and illegal to spend it. Now, why'd they do this? Yeah, okay. It is the 500 and the 1,000 rupee note that was scrapped almost overnight. Well, India has a problem with people paying taxes. There's a lot of people in India that do not pay national tax and keep a substantial amount of their wealth in cash. So the government, I may butcher this statistic, but I want to say somewhere that it was like only about 20% of the people in India pay taxes. Good for you guys, by the way. So it's probably going to get me in trouble. So the government decided a way to get around this was that chances are the very, very serious offenders of this probably keep loads of cash because that's the only way to do it. Because if you if you were to put it into a bank, it shows up somewhere on a digital ledger. So they said, okay, you got the 1,000 rupee note. It's worthless. It's worthless. So what you could do is you could go to a bank and you could exchange your old 1,000 rupee note for another new 1,000 rupee note. But in the process, the bank is going to be keeping track of how much money you got. And if you're coming in with a stack of cash, they're going to start asking questions. And chances are you're going to end up owing a shitload of money in taxes. And they did it all by saying that the thing that had value yesterday no longer has value today. I mean, how wild is that? Can you imagine? Now, in the case of the United States, the most common bill that is that's printed, that's counterfeit, is the $100 bill. And there has been a substantial movement to eliminate the $100 bill from circulation under the guise that it would reduce fraud and counterfeit. But I would contend that one of the major reasons why the federal government would like to eliminate the $100 bill is because storing physical cash now becomes more difficult. Because now you can no longer store cash in stacks of hundreds. You can only do it in stacks of 50s or 20s. And when you take the amount of physical space that you are using to store cash and you double it or quadruple it or more, then suddenly storing cash becomes prohibitive. And what do you do after that? Well, you got to store it in a bank. When you store cash in a bank, people know about it, and that means you got to pay taxes on it. Okay? This is a very, very important distinction. And it's important that you realize that the money in your wallet only has value because the government says it does. But the free market determines how much value. Now, in the case of how much value, that brings us to our next realization that we have to understand with respect to currency. We've established that it only has value because someone says it does. The value of the dollar goes down every year. Why? Because it is inherently inflationary. By that I mean that it is designed to decline in value every single year because it can be printed endlessly. Because as more dollars go into circulation, that means that more people have money, which means that the prices of things go up because naturally more people have money, so the prices go up, and all of the prices inflate. What we've seen is that salaries don't necessarily inflate. But the most important thing to understand is that a dollar that you earned in 1950 is worth significantly less than a dollar that you earn today in 2018. So if you are a saver, okay, you're somebody who actually puts money in the bank, you don't go out and blow it on $15 lattes or avocado toast, which I actually tried recently. It was very good. If you're a saver, this fucks you hard. And I say that because that's about the only way I can describe it. You are significantly impacted by inflationary currency. Because as a saver, it means when you put your money in a bank, it reduces in value every single year. And it used to be that, banks would pay you, 2, 3, 5% interest on your savings account. So the interest that you would earn on money in your savings account outpaced inflation. So that meant that your investment continued to grow every year. Now, of course, because the Federal Reserve, which is designed, or was supposed to be designed at least, to reduce or eliminate volatility within the U.S. dollar, has rock bottom interest rates. So banks are not charging anything close to interest rates, which means that they're also not they're not giving interest rates on savings accounts. So essentially, what this does is it makes you into a sucker. If you are a saver, you are a sucker because your money is worth less and less every single year. And it encourages massive spending. It encourages massive debt accumulation. Why? Because if the sooner you spend your money, the better. Because it's worth more today than it will be tomorrow. So if you buy a $40,000 car today, barring technological advancements and enhancements in value, you get more car for your money today than you do 5 years from now. It's a potential that a $40,000 car today will cost you $45,000 or $50,000 tomorrow, for a variety of other reasons. I might add. That's kind of a poor example, but the point is, it makes you into a sucker, and it encourages massive amounts of debt accumulation, because you want to spend as soon as you possibly can, because you want that money to start working for you today. So the other reason why this is a really great thing, mostly for governments, like the government in the United States, is because what it means is that over time, the actual amount of value that you have accumulated in debt, which in the case of the United States government is over $220 trillion, that is worth less every single year. So if we had, we have $20 trillion in debt, but 100 years from now, that $20 trillion could be worth, 10 trillion of today's dollars, to give you an example. So the value drops. Well, this is great for governments because they can just keep spending and spending and spending and spending, and the actual value of what they owe is worth less every single year. This is an inflationary currency. This is what it's designed to do. The entire world is ran this way, which is why you see government after government after government getting itself into trouble with debt because it's addicted to it. And they try to print their way out or to devalue their currency on the way out. And China is another example when you talk about currency manipulation. They intentionally devalue their currency to keep their labor costs low. So businesses go to China for labor because it's cheap. And the Chinese government manipulates their currency and does this on purpose. The problem is it keeps the Chinese people poor. It keeps them all poor because their currency is not worth anything if they spend it outside their country. They can't buy goods in Europe or the United States because it's all too expensive. So they stay poor. So if they want to buy cars, if they want to buy any goods or services that are sourced from outside the country, are incredibly expensive. But for the Chinese government, it's great because it brings in business, which gives them tax dollars. Do you guys see a commonality here? I know this is a lot. So I'm going to say we're going to just take a step back very quickly. We're almost through this. I'm almost to cryptocurrency. But see, the key is understanding why our system is the way it is today and what's wrong with it so that you can better appreciate the problems that cryptocurrency solves. I want to bring in one last aspect about things that can't happen here. I want to go back to some of the problems in 2008 that this thing was designed to solve, but we're going to fast forward in time from 2008 to around 2013. No, I apologize. That's probably incorrect. Yeah, 2013. Okay. Two major examples of shit that supposedly can't happen here, but probably will someday, is we had a look at Greece and Cyprus in 2013. And what we saw was, well, essentially for those of us in the United States, we saw our future. And I'm here to tell you folks, this is going to happen. Okay. I don't mean to sound like all apocalyptic. This is going to happen here. Okay. Because the amount of debt that our country has accumulated is unpayable. Unpayable. Mathematically impossible. There is not, I mean this in every literal sense of the word that I can apply this. There is not enough money in the world to pay for the things that we have promised people who are alive today. That is a mathematical fact. Not an opinion. It's a fact. This will happen here. Which is why what I'm telling you today, this could be the most important video that you've ever listened to from me. Not to pat myself on the back. In Cyprus, so Cyprus and Greece both they're both members of the EU, the European Union, and both of them were suffering extreme economic crisis because they had accumulated a massive amount of debt. Now, the difference between Greece and Cyprus and the United States is they can't print their own money, because they belong to the European Union, which is managed mainly by a set of centralized banks. So these countries all use the euro, and the idea was that they would all go to this centralized currency, and in response to that, the currency would maintain a significant amount of value, whereas all these countries used all of their own individual currencies, and everybody within the EU, with the exception of Great Britain, has done this. So the euro was born this way. The bottom line was that they can't print euros. So when they accumulate debt, it has to be paid back, and it has to be paid back in euros. So it's a similar situation to how states are in the United States. The federal government can run a deficit. States cannot. The states can't borrow with the exception of floating bonds, but they still have to pay the money back. And if you do a bond, you got to pay it back with interest. So they ended up in a situation where their debt that was accumulated, like they were having problems paying it back. So what did they do? Well, the banks in particular within these countries were having serious problems because they needed cash. So what ended up happening is the government came up with this crazy idea. It said, tell you what, we're going to go in, and anybody who's got more than 100,000 euros in a bank account, we're going to take it. They took it. They just reached in and took it. But of course, the bank's facilitating this. I'll link these articles. This one's from The Guardian. Headline, Cyprus bailout deal with EU closes bank and seizes large deposits. The draconian terms aimed at keeping Cyprus in the Eurozone included closure of the second largest bank and big losses for wealthy savers. This was part of the bailout deal for Cyprus. I won't read the whole piece, but this is part of it. Those with deposits of less than 100,000 euros will be spared, but those with more than 100,000 euros, many of them Russian, will lose billions of euros under draconian terms aimed at preventing the Mediterranean tax haven from becoming the first country forced out of the single currency, meaning the euro. The Cypriot government reportedly fought hard for the Bank of Cyprus to be spared, but the island's biggest bank will face huge restructuring. No bailout money will be used to recapitalize it. Instead, shareholders and bondholders will be hit. It is thought that depositors with more than 100,000 euros at the bank will be involved in the recapitalization and are expected to face losses of around 30%. That's a lot. Getting the bank up to healthy EU-mandated capital levels will be made harder by the fact that the Bank of Cyprus will inherit a €9 billion debt that it had with the European Central Bank. This is all part of the bailout deal. Another article from The Independent, which is a UK outfit, headline, customers at Cyprus's biggest bank stung by 60% raid on savings. It is the latest attempt to meet the terms of the IMF ECB bailout. Cyprus's central bank has confirmed that savers at the island's biggest bank will face a raid on around 60% of savings over 100,000 euros. Now, I know there's, right off the bat, there's some of you out there that may be like, who fucking cares? These are rich people. Okay, this is real money owned by real people that was earned by real people, okay? You could potentially, I know there's going to be people listening to this that are going to be like, these are rich people, who fucking cares? I need you to come to grips with the fact that the government and the banks decided on their own that they were going to go in and take people's money without their permission. If they did it to the wealthy people, now let's take a second. I want to address you folks. People who are wealthy have money to fund politicians. They have money to leave the country. They are the most mobile of all of the economic levels. They are the most capable of buying politicians of all the economic levels. They pay a vast majority of the taxes in these countries. Okay? These are the least likely people the government wants to fuck with. And if they don't have a problem going in and taking money from them, what makes you think that they're going to give a shit about taking money from you? Someone who doesn't fund politicians, someone who has no power or funds to leave, and someone who doesn't pay much in taxes. In the grand scheme of things, you don't amount to very much. Significantly less than someone who is more wealthy than you. Do you really think they're going to care about the hardships that they inflict on you when they don't even care about the hardships that they inflict on the people who have a lot more money? That's the thing you need to get through your skull. Is you are significantly less important than they are. And they didn't give a shit. The government didn't give a shit about messing with these people. Back to the article. This is one of the conditions of the controversial €10 billion bailout from the International Monetary Fund and the European Central Bank. Initial signs that bank depositors in the Bank of Cyprus would take a hit of 30 to 40% had already unnerved investors over the last week. This is 2013. But now depositors lose any savings over 100,000 euros. And this is the kicker. Ready? Are you ready for this? In return, they will get shares in the bank worth 37.5 cents of the 37.5% of the cash value. Happy? So we took your money, and in return, we gave you shares that were only worth 37 cents on the dollar of the cash value of what they took. Is this sinking in yet? Am I scaring you yet? Because if you're not scared, you're not listening. Cypriots are angry at the rescue's other associated costs, like the winding down of the island's second largest bank, Cyprus Popular Bank, also known as Laiki, like Laiki, and an unprecedented raid on deposits over 100,000 euros. The bank's assets will now be turned over to the Bank of Cyprus. At the Bank of Cyprus, about 22.5% of deposits over 100,000 euros will attract no interest. Got that? No interest will be paid on your money. The remaining 40% will continue to attract interest, but it will not be repaid unless the bank does well. So if you got over 100,000 euros in the bank, so you saved all of this money, you got this massive stack of cash in the bank, right? Well, congratulations. It's not going to be, whatever funds manage to not be taken by the bank or the government. 40% of what was it? Where'd my numbers go? 22% of the deposits will not receive any interest whatsoever. So the bank gets to use your money for free. And the remaining 40% of the money will pay interest, but only if the bank succeeds. Am I starting to make sense now? And by the way, the people who they have no control over this because the first thinking is, well, just go get your fucking money. You can't. The banks were shut down. You couldn't go get your money. They put restrictions on what you can go and withdraw to prevent a run on the banks, to prevent the banks from losing their liquidity. Oh boy. Let's talk about Greece. Greece had a very similar issue. In fact, Greece was much worse than Cyprus. But I want to talk about specifically about losing access to your own cash. Okay, so we've talked about your cash being seized. So what about all of the people who had less than 100,000 euros in Cyprus, right? You still couldn't get your money. The similar situation happened in Greece, where there was a bail-in in Greece because their government paid and owed like, it was like 150% of GDP for what their debt was. It was insane. But what about all the average people, the people who don't have 100,000 euros in the bank, right? This is from a website called The Crux, C-R-U-X, thecrux.com. This is from 2013. Headline: 2 months later, Greeks still can't fully access their own cash. If you wake up tomorrow and your bank account is frozen, what will you do? That's a really good question, by the way. You probably remember when the financial crisis in Greece was dominating headlines a few weeks ago. For years, Greece spent more than it took in. This led to a financial crisis that looked like it might destroy Europe's financial system. True story. The Greek government closed all banks to prevent people from withdrawing all of their money and crashing the banking system. Greek citizens could only withdraw, you ready for this? 60 euros, $67 at the time, of their own money each day from ATMs. No word as to like how much they could do in wire transfers or anything like that. But the fact is, but it doesn't matter because electronic money at this point in time, it's all at risk of being seized at any moment. If the bail-in over 100,000 euros doesn't work, then they're going to start going down and seizing more cash. So people want to get their money out of the bank as soon as possible because cash in hand, it's as the old saying goes, one bird in hand is worth two in the bush, meaning what you have in your hand is worth significantly more than what you can't see or get to or even know if it exists. In this case, electronic money. The Greek government, $67, 60 euros per day. European authorities eventually gave Greece a bailout and the crisis dropped from the headlines. But here's something you probably haven't heard from the mainstream media. It's now been 2 months and the Greek people still can't fully access their own cash. From Reuters, Greek banks are set to keep broad cash controls in place for months until fresh money arrives from Europe and with it, sweeping restructuring. Broad cash controls, meaning Greek banks are essentially frozen. Greek people can withdraw later on. So this is at the current time of the article writing, 420 euros or $460 per week of their own money. The longer it takes, the more critical the bank's condition becomes, as a 420 euro weekly limit on cash withdrawals chokes the economy and borrowers' ability to repay loans. The banks are in a deep freeze, but the economy is getting weaker, said one official, pointing to a steady rise in loans that are not being repaid. Well, fuck, why not? I mean, you don't have the money to repay the loans, right? One Greek farmer can't get enough cash to run his own business. So in this case with Greece, it wasn't just ATM withdrawals. It was the ability to even get your cash out. And in fact, it's not in the article, but I want to say that Greece actually was preventing people from sending money outside the country. So they were preventing people from getting money out of the country into a safe haven somewhere or potentially exchanging it into another currency somewhere else. So they weren't even allowing money to leave the country. It's not in the article, but I recall that could be the case. I could be wrong. If they didn't do it, they should have. One Greek farmer can't get enough cash to run his own business. It's a nightmare. I owe many people money now, gas stations and firms that service machinery. I have to go to the bank every single day, and the money I can take out is not enough. So what did they do? You got to find a way, right? Short on cash, Greek people have resorted to bartering. Reuters says a rising number of Greeks in rural areas are swapping goods and services in cashless transactions. Ooh, get ready. Cashless transactions. Sound familiar? Since the government shut down banks on June 28th for 3 weeks. 3 weeks they were shut down. Do any of you out there have enough cash on hand to survive the banks being shut down for 3 weeks? Huh? Anybody? If you don't, you might want to consider figuring that out. Restricted cash withdrawals and banned transfers abroad to halt a run on deposits and prevent a collapse of the banks. Bartering, this is what the website defines it as, means exchanging goods and services without using money. It is how humans did businesses thousands of years ago. Squeezed on all sides, the 41-year-old farmer began informal bartering to get around the cash crunch. He now pays some of his workers in kind with his clover crop and exchanges equipment with other farmers instead of buying or renting machinery. This is what happens in a cashless society. People find other things of value. Remember what I said about people talking about the value of cryptocurrency? People find other things of value to exchange as currency. All right. The last bit. This is from Forbes. And this is also a 2013 article. Headline, Why a Cyprus-like Seizure of Your Money Can Happen Here. And by here, I mean the United States. Brace yourselves, folks. This is where I'm going to bring it all home. This story first appeared in the April 15, 2013 issue of Forbes. Don't put it past our politicians to try it in a financial emergency. The breaking of contracts by the United States government unfortunately has happened before, and what is currently underway in Cyprus shows that feckless politicos will continue to try such things. In 1933 and 34, amid the depths of the Great Depression, the United States government seized the American people's gold holdings. Now, I need to back up here because you got to remember, some of you are not familiar with the gold standard. And essentially what it was is a way to stabilize the value of the dollar. We used gold as a backing for U.S. currency. And what that means is when a currency is backed by something, it means that essentially we have exchanged the value of one thing for another because the thing with value exists someplace. In this case, it was gold. So the United States government said, we're going to have a gold standard with the U.S. dollar. For every dollar of gold that we have in the Federal Reserve or in a vault somewhere under control of the government, we will print a dollar in circulation. That's what would give the dollar value. The dollar didn't have value because the United States government merely said it did. The dollar had value because it was backed by physical gold that it sat in a vault somewhere. So in this case, during the Great Depression, the government was in need of printing more cash. Well, you can't just print cash because you have to have an equal value of gold to dollars. Well, so what they do, they made it illegal for you to have gold as an American citizen, and all your gold was seized. I recall reading an article where years after this happened, I think this was like in the 50s or so, or 50s or 60s maybe, that there was a gentleman who brought in a bunch of gold bars to a bank. I think he was either trying to deposit them or get the equivalent cash value, and he was arrested because it was illegal to have gold, and he had it the whole time. So the U.S. government seized the American people's gold holdings. From that point, I'm back to the article. From that point until 1975, it was illegal for Americans to own gold other than in some forms of jewelry or collector's coins. So basically, if you had gold bars, you can't have them. In the panic of the Depression years, the courts upheld this unconstitutional confiscation, yet the people received dollars in return. Yes, people received dollars in return for their holdings of the yellow metal, but the dollar itself was formally devalued by 40%. So you give your gold over, but the dollar was already devalued by 40%. Do you see a problem here? Moreover, the U.S. government advocated private commercial contracts containing the so-called gold clause, which allowed creditors to receive payments in either dollars or gold. So contracts that they had, commercial contracts that they had that allowed creditors to receive payments in dollars or gold, the government broke those. Sorry, we said we pay you in gold. We're not doing that now. In the 1970s, President Richard Nixon annulled contracts selling soybeans to Japan. This was done for political reasons. The United States soybean buyers have been complaining about high prices, and Nixon felt keeping the product here would mollify them. Of course, the real reason that the prices of soybeans and other agricultural commodities were rising is that Nixon and the Federal Reserve were deliberately undermining the value of the U.S. dollar. Japan responded by investing in Brazil, which became one of the major soybean competitors. In 2009, the Obama administration pushed through a brazenly political restructuring of the bankrupt General Motors and Chrysler, and huge payoffs were made to the United Auto Workers, a pro-Obama union, at the expense of bondholders. So this was a situation where in the case of collapse of businesses, the bondholders, shareholders, they all get paid first People who invested in the company in the form of bonds, they get paid first. The government went in and said, no, we're going to pay the unions first. The bondholders get whatever's left. That was a complete breach of the contract. Banks signed off on the deal because they had no choice, because they had been nationalized. Their survival depended on the whims of Washington. So they wouldn't dare piss off the government, because they would risk the government saying, hey, you know that bailout we were going to give you? Just kidding. Once again, the courts turned their backs on this patently unconstitutional exercise. There have been rumblings from some revenue-hungry Democrats about finding ways to tap into individuals' retirement incomes, aka 401ks. Several years ago, Argentina nationalized the private pension plans of its populace, and recently Cyprus has been talking about taking similar action. One can already hear our politicians' rationale. Most of the money in 401ks is pre-tax dollars and grows tax-free, depriving the government of needed revenue, because according to the United States government, all money belongs to it. It just allows you to keep some. Why not integrate them with Social Security and then means test the benefits? Holders of Roth IRAs may be in for a rude shock. Their contributions have been made with after-tax dollars, with the promise that the ensuing benefits would be exempt from federal income tax. Slapping a special emergency levy on these assets will become an irresistible temptation for politicians as the pot of assets gets bigger. Impossible? Your Social Security contributions, quote unquote, are made with after-tax dollars, and it was promised that those benefits would be tax-free. But Washington started chipping away at the vow back in the 1980s, and today millions of Social Security recipients find a portion of their benefits subject to tax. And the article goes on and on and on. But the point is that I want to hammer home is this shit can happen anywhere, and it most likely will. Like I said, it most likely will. There will come a day when the United States government in particular, but European governments are heading in the same direction, where they will have amassed so much debt that they will turn to any sources of liquidity that they could possibly find, and they will seize it, and you will have no way of fighting it, and your money will be gone. And it'll all be done under the guise of national security and saving the children. Okay. Let's take a breather real quick. That's a lot. I'm setting it up for you. I'm setting it up. My God, how long have we been talking now? Well over an hour. I'm setting this up because people right now don't see any value in cryptocurrency unless they're in the market. They don't understand why it has quote-unquote value. And it's all being played as a Ponzi scheme, as a game of suckers where the goal is to sell it to another sucker for more than you paid for it, things like that. That's what cryptocurrency is being sold as in that respect. In order to understand why cryptocurrency has value, you have to understand the problems that it solves. And as I believe I have clearly laid out, our current fiat currency economic system is plagued with problems. Cash only has value if the government says it does, of which we've seen instances where governments around the world have arbitrarily just declared certain paper notes as worthless. They can do so at any time for any reason. There's nothing you could do about it. We've seen instances where economic crises have led to the seizing of people's cash without their permission. And if you're lucky, you got something back for it, but many people didn't. The money is gone. It's gone. And there's nothing you can do about it. And even if you get into court, it'll take you years and years and years, and you've lost a significant amount of earning potential in that money. And because it's inflationary, by the time you get your hands on that money, it's worth less than when you had it previously. Okay? All of these things are enormous problems. Bitcoin solves a tremendous amount of them. So let's talk about Bitcoin in particular and what problems it solves. When Satoshi Nakamoto actually made Bitcoin, he modeled it primarily after gold. Now, think about what gives gold value, because gold doesn't have a tremendous amount of other economic properties outside of currency. Okay, it has some, there are some like industrial uses for it, but by and large, it doesn't have a tremendous amount of it can't be used for a tremendous amount of things. Think about like copper. Okay, we use copper for tons of stuff, copper and wiring in particular, but copper's not worth anything really. It is in significantly large amounts, mind you. But my point is that copper has significantly more industrial uses than gold, but it's worth less. the characteristics of gold are it's rare. It's a rare metal. It's difficult to mine. It's difficult to produce. It can't be copied or faked. You can't, you got people, you have these stories of alchemists throughout time trying to turn lead into gold. It can't be copied. It can't be, it's hard. It's difficult to mine and produce. And it's a scarce commodity. Okay. So these are some of the characteristics of things that we would use as value and in particular, it can't be faked, although a lot of people do try. But some of the downsides of gold in particular, okay? Number one, it's very difficult to transport. So if you have a large amount of wealth in gold, it's difficult to transport that gold. You can't get it out of the country very easily. It can't be carried in your pocket, okay? In the case it's difficult to transport, it's also difficult to spend, because to break gold up into amounts that you can use to spend on things it's very difficult to do that. We've tried to do it with the case of gold coins, and there's stories of, a long time ago where people would bite off chunks of gold coins with their teeth and they would give them to people. It's not very divisible. It's not easily divisible. It's hard to spend. It's not very easily divisible, and it's very difficult to transport. In this case, Bitcoin has all of the positives of gold and none of the negatives. So, like I've mentioned at the very early part of this video, that because of the cryptographic nature of Bitcoin, it can't be faked. Because the computation that is used to create Bitcoin makes it so that you cannot duplicate it in the same respects that you could duplicate any other digital asset out there. You could make another Bitcoin, but it would become a unique Bitcoin. So Bitcoin is easily divisible, number one, because each coin, you may not know this, but you don't buy Bitcoin in single coins. It's divisible actually up to 100 million times. So you can have, each unit is considered, it's called a Satoshi. So it takes 100 million Satoshis to equal one Bitcoin. So the Bitcoins can be divided up into, 100 million ways, and you can match whatever specific value it is that you're trying to achieve. It is easy to transport because Bitcoin can be sent anywhere in the world from any computer system. And if you use a hardware storage device to keep Bitcoin locally, you can put it in your pocket. You can carry virtually an unlimited sum of money in your pocket anywhere in the world. Bitcoin is difficult to produce. In this case, the creation process prevents you from copying Bitcoin, but the mining process is somewhat difficult. But the number one thing also is that it's very scarce, and the scarcity is inherently built into the code. And in this case, with respect to Bitcoin, 21 million coins is the maximum amount that can be created. So what you have here is a currency that is deflationary. Not inflationary like the US dollar, but deflationary because of its rarity and scarcity, because there's a finite amount of coins. Now, I'm not going to get into the notion of soft forks and hard forks per se and how other coins can be created, because that is, of course, a concern. Except to talk about how people can maintain the value of Bitcoin through consensus. If that doesn't mean anything to you, that's just hang on. So another characteristic of Bitcoin is that you are your own bank. You don't need a corporation in order to funnel your money from one person to the next. If you want to pay someone in Bitcoin, you can pay them directly. And you can pay them directly from anywhere in the world. You can pay them directly in person. You can pay them directly over the internet. And that's done through a decentralized network. Now, decentralization is a real big buzzword that you hear within cryptocurrency. Now, so in this case, decentralization, in terms of how it looks, is the exact opposite of a centralized financial system or a centralized financial authority like Visa or MasterCard or Chase Bank. And the network is ran by people who, quote unquote, mine Bitcoin. So mining was developed as an incentive for people to run the network. So when you mine, you're basically running the ledger, and the ledger is what people call blockchain. Blockchain essentially is a running ledger of Bitcoin, every transaction that's ever taken place since the beginning of Bitcoin's time period. And the ledger is decentralized, meaning there's no one central place that the blockchain exists. And it uses miners to run the network using computer power, and in exchange for doing this, they are rewarded with Bitcoin. Now, the system is inherently designed to reward people with Bitcoin less and less and less as we get closer to the total amount of 21 million coins, but they're also compensated through transaction fees, which have recently become a little bit of a problem. Only because, well, I'll interject that they've become a problem because one of the major exchange providers, it turns out that their technology is highly inefficient, and they've been absolutely just crushing the network. These are the kind of growing pains that you have with technology. So Bitcoin it's scarce like gold because it can only have 21 million coins printed. The code for Bitcoin is on GitHub. It's viewable publicly. It's publicly accessible, open source code. Anybody can look at it. How the code is maintained is through consensus, because the way the system operates is that in order for changes to be made in the code, 100% of all the miners have to basically run that code on their system. There are conditions where you can create a fork where a new coin is created. However, that new coin, unless it is accepted by the market, is utterly worthless. So you would create a coin that has absolutely no value or use because it's not recognized by anybody as having any value or use. So people are driven towards doing things that only enhance the value of Bitcoin. So as an example, the notion is, well, what if somebody just decided that they wanted to raise the cap from 21 million to 42 million Bitcoins? Well, you could actually create a coin that does this using Bitcoin's code. But the thing is that miners have an incentive to maintain the value of the Bitcoins that they've earned, or to maintain the value of Bitcoin in general. And as such, they're not going to do anything that devalues the coin, including increasing the amount of them that are in circulation, because it devalues the ones that you already have by half. Suddenly Bitcoin goes from 15,000 to 7,500. Not cool, you know? So consensus amongst the entire population of people who are mining is what keeps changes from happening in the system that ultimately damage the coin. So the decentralized nature is not only in the fact that the ledger itself is processed by a random computer system anywhere in the world, meaning that you don't need a centralized authority to use it, but also the coin itself maintains its integrity, and no changes are made except changes that 100% of the people in the network believe will enhance it. This makes it incredibly versatile and very, very solidly protected against major manipulation. It's not perfect, but if you think about right now, where the federal government essentially has total control over the dollar and decides whatever it wants to do with respect to the dollar, and even the Federal Reserve, which operates almost behind a cloak of secrecy, the public doesn't have any input into this, whereas the public does have input into Bitcoin. So what gives Bitcoin value is the fact that because you're your own bank, no one can seize my Bitcoin without my permission. Or, of course, there have been instances of hacking. And the thing to understand about Bitcoin is that it uses a concept known as a public key, private key. The private keys, if you think of a public key almost as a lock that's visible to anybody, anybody can see the lock, anybody can see the shape of the lock and what it looks like, but nobody knows what the key looks like that fits in, and nobody can duplicate that key. You have the private key. That allows you to control the Bitcoin. You don't actually have any physical possession of Bitcoin. It's not like a file that you download on your computer or anything like that. The private keys of the Bitcoin are actually what you control. The Bitcoin exists on the blockchain, which is decentralized and spread across the entire world. You just simply change ownership of that of that coin between yourself and someone else. It's not a physical ownership in the sense of what you think about cash. It would almost be like having cash in a bank account and the account itself changing owners, but the money never actually moves. It's very similar to that. So the aspects that are solved by this are enormous within our financial system, because now I don't need permission from anybody to send someone money. I don't need to ask a bank if it's okay to buy at this particular merchant. The transactions are irreversible. So once you send money to somebody, I mean, think about all those times, like through, if any of you guys have ever done shit through PayPal and people have, sent in complaints or protests or whatever they call them. And PayPal just like takes your money, like that doesn't happen with Bitcoin. The transactions cannot be reversed. They're irreversible transactions. So these are some of the things that give Bitcoin value. And I'm here to tell you that this is, without a doubt in my mind, the future of money. They call Bitcoin the internet of money, but cryptocurrency is the future of money. Because we are faced with two possible futures, both of which are cashless. Cash is going to die. It is just a fact, because it has been, the cashless society has been made too incredibly convenient for people. Using cash is cumbersome. It takes time. You got to carry around change. It is so much more convenient to just use digital currency. But one of two possible futures are going to exist in this world. One of them is a digital cash system, which is controlled by a centralized authority, which at any time, for any reason, can seize all of your money and you have access to none of it. That central authority will allow, you will need permission to access your money from someone who doesn't know you, doesn't care about you, and has their own ulterior motives. You will have to submit to that authority at every step of the way. And should you, you commit a crime, your funds are seized. If you don't pay your taxes, your funds are seized. If the banks make really bad investments and they're at risk of going under, they can seize your cash. You don't actually have ownership of your money in a centralized authoritarian system like that. The second future is a future that's governed by cryptocurrency, in which every individual is their own bank, in which the money that they spend is spent without anybody else's permission, can be sent anywhere in the world, cannot be duplicated, cannot be faked. Because of the way that the blockchain works, if you try to spend the same Bitcoin somewhere else, the blockchain is, you don't have a choice over who makes the confirmations and the changes to the ledger. And once they make that change is then confirmed by other miners and in a completely anonymous fashion. There's no control over it. So you can't lie to the system, because even if you manage to lie to one component of that system, the rest of the components are going to see the mistake and they're going to fix it. They're not going to accept it. So there's no way to fake it. There's no way to duplicate it, with the exception of a soft fork and a hard fork, which is for a different day. And for instance, like think about some of these third world countries, some of these, as the President Trump would say, some of these shithole countries out there, not individuals, countries. Venezuela right now, for example, that's a real shithole, and anybody who lives there would agree with me. Is facing a significant devaluing of their currency. Their currency is inflated by well over 2,000%. So people are losing savings value tremendously. People are starving. They are dying because their socialist government has absolutely decimated their economy. People in Venezuela have started to use cryptocurrency because, number one, their currency is being incredibly devalued. So they're trying to preserve and lock in whatever value they can of their own currency, despite the fact that Bitcoin's value is very volatile. Number two, they can buy goods and services anywhere in the world with it, and they can pay each other with it and run their businesses that way. Number three, they can mine it using computer systems. So they can actually generate wealth for themselves by mining cryptocurrency or mining Bitcoin. That's been a real problem because the mining machines have actually been seized by law enforcement, and then, of course, the law enforcement people turn them on and mine for themselves. But some Venezuelans have been using that as a mechanism to feed themselves and feed their families. They are using cryptocurrency almost exclusively in any place they possibly can because it's a way of still being able to use currency to get things without having to wheelbarrow their fucking money through the streets. There are some African nations. I don't know if I don't think it's Kenya. It could be Nigeria, but specifically it escapes me. But there are some African nations that are cashless nations, not because they are technologically advanced, but because there's no way to print any currency. Like there's just no way to create any paper money. That some of these countries started out by trading cell phone minutes. That was used as a form of currency, that they would trade minutes. And many of them have now switched to cryptocurrency because, again, it's a way that they can pay each other in a currency that they see value in. So, I mean, these are all societies that are operating without cash, essentially. Some of a necessity, but both cases out of necessity. One because they can't and they don't have access to paper money, and the other because the paper money is worth almost nothing. So, I mean, to say that it's not possible ignores like modern day reality. And I'm not here to say that Bitcoin is the end all be all solution, because unfortunately, one of the major problems with Bitcoin is there is some anonymity with Bitcoin, but it's not totally anonymous. And I don't know about you, but it's nobody's business how I spend my money. Now, there's always arguments about the fact that, it's used by criminals. Let me think about this for a second. Number one, the argument too is that Bitcoin is used to launder money. I would like to add that the largest single money laundering source in the world is HSBC, which is a bank, I might add. They're the single largest known case of money laundering ever, as far as I'm aware. So the biggest known offender of money laundering is a bank. Last I checked, there's an incredible amount of crime that's conducted with cash. Criminals use cash all the time to buy hitmen, to buy drugs, to buy politicians. There's cash is used in a variety of crimes, but I don't see anybody abandoning cash because it could be used to commit crimes. I don't see anybody abandoning banks because banks are the single largest source of money laundering anywhere. So these arguments with respect to Bitcoin about how it's a money laundering scheme or it's used by criminals and don't use the currency because of that are absurd. Because I don't see anybody complaining about cash being used in this respect. So all of those are the kinds of things that you're going to hear with respect to argumentation against Bitcoin. But understand something very simply is that Bitcoin is a serious threat to the financial institution because it renders them all worthless. I don't need a bank. I don't need a bank to keep my Bitcoin. I can keep all of my Bitcoin on a hardware wallet that's guarded with multiple forms of security that no one can get to. And I can have it with me anytime I want, anywhere I want. I can carry $100 million of Bitcoin in my pocket. Can you carry $100 million in cash? Can you carry $100 million in gold? I bet you can't. I mean, think about all the security that you would need to do that, let alone the manpower. That's some of the advantages that cash, well, I wouldn't say it's an advantage, but it's one of the reasons why utilizing cash or gold is so difficult is because it's hard to move. It's difficult to store. You need physical space, which is why a digital asset is so much more superior. And these are the things that give Bitcoin and cryptocurrency in general value. Because the value argument is the one that's made the most. All of these, you can look at any of these financial pundits all the way up to Warren Buffett, who claim that Bitcoin has no value. And they couldn't be more wrong. And I need you to understand that all of these financial pundits are operating from a little box that they have built for themselves over the years, and they can't see their way out. For any of you who have played video games for the last 15 years, digital currency usage is nothing unusual. And neither is the exchange of real dollars or real paper currency for digital cash. All of the gold farmers, whether it's in World of Warcraft or any other online games, the notion of exchanging fiat currency for digital assets or digital cash is not a new thing. Now, there's one other thing that occurred to me that I wanted to talk to you about. And I want to talk about the deflationary nature of Bitcoin and why this is potentially one of the best possible futures that you can imagine for yourself. A deflationary-based economy is not a perfect world, okay? Just like capitalism is not a perfect economic system, but it is by far the best. A deflationary economy would be completely different than the one that we live in now. And this would be an economy where saving money would be incredibly rewarding because Bitcoin has a finite amount of coins that can be created. As more and more people acquire Bitcoin, it means less and less Bitcoin will be on the open market and available to use because people will be keeping it, storing it, saving it. What that means is in order for you as a business or an individual to entice someone to part with their Bitcoin, you will have to provide more and more value as time goes on. As more coins are accumulated by people and as more coins are saved by people, that means that people are spending less, and that means that you will have to provide more value or lower prices or both in order to entice people to part with their money, which means that the worth of Bitcoin will increase, and this is known as deflation. When the US dollar deflates, it means that a dollar is worth more than it was previously. The value of the dollar goes up. It's kind of an inverse relationship to how you would normally think. So I want to paint a picture of what a deflationary economy would look like. Some of you out there who do not share political views with me are really concerned about income inequality. All right. You're also very concerned about people being poor. All right. Imagine a situation where you could potentially pull yourself out of poverty by just saving money. And I'm not even talking about, that sounds ridiculous. But, of course, if you just save money, you can get out of poverty. Let me contrast that with the reason why we have a growing disparity between the poor and the rich. Right now, the prevailing notion is that capitalism is to blame. That it's the poor or that's the rich exploiting the poor. The reason why there's a growing gap between the poor and the rich is because of the dollar, not because of greedy people or greedy corporations. It's because of the way the dollar is designed. Let me explain. Rich people, or we'll just say wealthy people. I kind of hate using the term rich. Wealthy people take dollars and buy assets. They buy real estate, they buy stocks, they buy bonds, they buy companies, they buy and build businesses which generate money. They buy assets. Gold is an asset, okay? Assets have a tendency to appreciate as time goes on, either because of their value increasing or because the value of the dollar goes down. Gold being a prime example of this. Gold does not increase in value. The dollar decreases in value, okay? The value of gold is static. If you think of the value of gold as a factor, as a x equals 1, okay? The value of the dollar is probably like 0.05, all right? And the value of the dollar goes up to 0.0. If the value of the dollar goes from 0.05 to 0.1, then gold per ounce is cheaper. But that's not because gold lost value, because the value of gold is 1. It's always 1. But it's because the dollar itself is now worth more. That's why the price changed. That's why the price of gold continuously goes up, because of inflation, because the value of the dollar goes down. If suddenly tomorrow the value of the dollar was to skyrocket, one possible future, as an example, is if all of the digital cash in America was locked down, you would suddenly see a split in currency. You would see one price for digital cash, which is difficult to get to and could be seized at any time, and another price for physical cash, because physical cash is real and you can hold it in your hand. The value of the physical cash would be would be much, much higher. You know, because digital cash is risky, whereas paper cash is very safe. The price of gold would most likely plummet because the dollar itself was worth more in this potential situation. But anything that would cause a dollar to deflate would cause gold prices to crash. Okay. People buy gold because they lock in the value of their dollar in theory at the time that they buy it. Assets like houses and things like in real estate are the same way. So wealthy people buy assets. Those assets lock in the value of their dollars at that time, okay? So their wealth is able to grow because the value of the dollars that they spent are locked in and most likely appreciate over time. As real estate, becomes more valuable because, if you bought a plot of land where the city of Chicago is in the late 1800s, and you probably, you paid, next to nothing, and then you held it for 100 years, it's going to appreciate in value because it's rare, right? So assets appreciate in value. Now, on the complete opposite end, you have people in poverty that are using cash just to survive, just to have a roof over their head, just to have food, just to have electricity, maybe have transportation to get themselves to work. They never get ahead because the dollars that they are using to buy goods and services are worth less every single year. So in order to maintain your standard of living, if you have very little money or if you live paycheck to paycheck, is you have to continuously make more money every single year. Otherwise, your buying power goes down. Okay? Imagine a world where that was almost exactly opposite, where the difference was not between those who are wealthy and those who are poor, but those who spend and those who save. In a world of Bitcoin only, it would be vastly different than anything we have ever experienced, because now every single purchase is scrutinized. Every single purchase is called into question, because if I spend Bitcoin today and the value of Bitcoin a year from now goes up 20%, that means that the goods that I bought today will be worth less per Bitcoin a year from now. So you seriously start to question everything that you buy, because it may be more worthwhile to keep your money in the bank, or to, in this case, keeping the money yourself. It may be more worthwhile to hold on to the Bitcoin and live an incredibly frugal lifestyle. You could potentially be very wealthy with very little. So the consumerism and the consumption would be virtually, I want to say wiped out, but it would be significantly reduced, because and the things that you buy would over time become cheaper and cheaper and cheaper. Now, like I said, this is not a perfect scenario. But what it would do is it would return a tremendous amount of value to the people who save their money. And if you did nothing but spend, you would continuously find yourself broke. And I don't mean just in a normal sense. What I mean is that you would realize that if you would have saved that money and not spent it, you would have or if you would have just simply have deferred your spending, you could have gotten more for the same amount of money. So you'd be sitting here thinking like, oh man, I need a new car. And the new car cost 1.5 Bitcoin. Okay. 1.5 Bitcoin for a new car. Yeah. But if I wait, I could probably get another 2 years out of this car. Then if I was to spend 1.5 Bitcoin in a car 2 years from now, instead of buying a Toyota, I could buy a Lexus. Or instead of a Lexus, I could buy a really nice BMW. Or a really nice Mercedes. And all you have to do is wait and not spend. Could you imagine what that would be like? Can you imagine a world where deferring pleasure, deferring expenses could make you rich? Could you imagine a world where if you didn't have a lot of money, all you had to do was wait? All you had to do was wait a few years? And suddenly the money that you have is actually worth more? This is the kind of future that Bitcoin could provide. one where the currency deflates because of its scarcity. And over time, businesses would have to provide more and more value to entice people to give up their cash. It would be vastly different than what we know. And debt would be a terrible thing. You wouldn't want to be in debt, because the money that you're having to use to service that debt would probably appreciate more if you just didn't spend it. It'd be like the difference between, like, do I put money in a 401k when the market's going crazy, or do I take that money and pay off credit card debt? Some financial advisors would tell you, don't worry about the debt. Put your money in the market, because your money is going to be worth more as the market goes up than it would be if you were to pay down your debt. A similar argument has been made to me recently with respect to paying off homes. If you take the money, if you have a 30-year fix, you have a 30-year mortgage, as opposed to spending extra money to pay your house off in 15 years. If you took that same money and you put it in the market, you could make tremendously more than whatever interest that you would save by paying off your house early, if that makes sense. It's also the same argument that's made that if you take the $60,000 that people use to go to college and you were to put that into an investment, by the time you retire, you would retire a millionaire. That you could make over $1 million with the money that you use to go to college. Same kind of principle. This is the kind of stuff that gives cryptocurrency value. Now, there are a ton of other currencies that do a ton of different things, and some of them are not even designed to be money. And that would take a much, much longer discussion to talk about. But all of this is why I have personally become heavily invested in Bitcoin. Yes, it's a speculative investment. Yes, I would like to make some good money. Yes, I have already made decent money on Bitcoin. But I hold it because I truly believe that it's the future of money. And I take a lot of comfort in knowing that if my bank account was not accessible tomorrow, I would still have access to something that has value. And in fact, chances are if everybody's bank accounts were seized tomorrow, you'd see the value of the price of Bitcoin skyrocket as people tried to get their money into something that they could take physical possession of in the most digital sense that you can imagine. Over time, I think people are going to start to understand that they're held prisoner by our current financial system, and that you have to submit to a higher authority at almost every turn. I mean, I went into the bank last week. I had to go cash a check for a side gig that I'm working, and I hadn't cashed a check in years. So I go into the bank, and I was disgusted with the process, which is such a weird thing because I've never felt that way about going into a bank before. You go into a bank, it's just what you do. I was disgusted. Even though the staff there were incredibly friendly, we had a really great conversation about the flu season. Very friendly, happy people. I was disgusted. I felt nauseous because I thought, here I am doing business with another company for an exchange of services, and I have to go to a bank to get my money. I have to go ask permission to take money out of one person's account and put it into another. I needed an intermediary to do this because I wasn't being paid in cash. I was being paid in digital cash, essentially. And I was disgusted by this because I thought if we did this in Bitcoin, I could have been paid immediately. I've been like, oh, here, QR code, bloop, done. Now Bitcoin's got problems. The technology is not perfect, and I'm not here to tell you that this is it. Okay, technology is constantly being innovated, it's being improved, and that's the advantage here, is that people are going to see problems within the cryptocurrency world, and they're going to be solved. And I have my own feelings about where things are going to go, but the reason why I wanted to do this podcast is because I feel like I needed to use this platform to get out the word, I guess. Does it mean that Bitcoin is going to be worth $15,000 or $12,000 or anything like that today or tomorrow? No. There's articles all over the internet talking about the recent volatility that we've had and how Bitcoin has dropped 50% from its high at 20,000. I'm I'm not the least bit worried. I watched my portfolio tank 40% in 24 hours. Without giving you details, it's not an insignificant amount of money, okay? I'm not the least bit worried. It's already coming back today. It doesn't mean that it will. But the point is not so much the price, because again, that's focusing on it being a speculative asset. Eventually, I'm going to be able to spend this money. I mean, in some cases, you already can. You can buy plane tickets with Bitcoin. You can buy computer equipment with Bitcoin. You can even buy real estate with Bitcoin. And as the value grows, as it becomes more valuable, and as more people acquire the currency, more and more businesses are going to start accommodating it because it's a source of wealth that's untapped. If you're a business and you don't accept Bitcoin, there's a whole segment of the population that you're not accessing. And that's why you started seeing some of these companies that started dealing in cryptocurrency, you've seen their value skyrocket because they know there are people out there with massive amounts of Bitcoin that have no way to get the money out of the market because you can't spend it on anything right now. That's going to change. It's absolutely going to change. I'm not going to tell you whether you should invest in Bitcoin or not. That's a decision that you have to make. I have chosen to do it. I have put my own money into it because I believe that this is the future of money. More so, this is the future of money that I would like to see. A future that doesn't involve central authorities. A future that doesn't give strangers the ability to seize my cash that I've worked for, that I've earned, that's my property, that belongs to me, that people who could seize my cash because they make bad decisions in their own investment world. You don't need that. I mean, we already have a lending platform within the cryptography world. It's a company called Salt. And Salt uses Bitcoin as collateral. They use a few other currencies as collateral too. And they provide loans. I mean, and the thing is you don't need a credit check. You don't need a credit check for it because you're putting up your own collateral. You're putting up your own collateral. It's kind of the same thing as taking a loan out on a house. But could you imagine buying a house and not needing a credit check? I mean, seriously. Where the bank's like, well, let's face facts. If you don't pay it back, we'll just take the house, right? But that factors into your interest rate, but that also factors into how much money you can get. I mean, so imagine being able to take a loan and you not need a credit check. All they need to know is, can you provide the collateral? These are the kinds of things, and it's a direct relationship with another company. So, I mean, these are all the kinds of problems that will be solved in the future. But already today, you're already seeing some of the major financial needs being met by this technology. And my firm opinion is if the longer you stay out, the longer you ignore it, the massive amount of opportunity that you're gonna miss out on. And I'm not even just talking necessarily about earning potential, but that's there. It's about being able to free yourself from the stranglehold of our financial system as it exists today. Sadly, my landlord still takes payments in cash. Everything still takes payments in cash. If I could live 100% on Bitcoin right now, I would do it in a heartbeat. I'd absolutely do it. Because it's money that I have control over and no one else. So I think that about wraps it up for today. We're coming up on almost 2 hours here. And if you've managed to listen to this entire thing, thank you very much for your time and attention. Because after all, that is the single most valuable commodity that any of us have is our time, because it is, like Bitcoin, extremely limited. I really hope you enjoyed all of the information provided today. I recognize and realize that I may not get everything right because this is literally all coming off the top of my head. But I do believe the general principle of everything that I've said to be absolutely true. And I certainly hope that you will take a significantly more detailed look into the world of cryptography and crypto assets and recognize that you have a choice over what type of future we are all going to live in. And I certainly hope that you will join me in a future that does not submit to centralized authority, to people who use your money to make money for themselves. And then when they screw up, they take your money without your permission and simply use it however they see fit. This is not the kind of world that I want to live in. I want to live in a world of accountability, a world of consequences, and a world where I don't need anybody else in the middle of a transaction between me and somebody else I'm doing business with. So thank you very, very much for listening to me, guys. This has been Flashwing, and until whenever it is I come back here, we'll see you out there.